Welcome and thank you for joining us today, either live or watching the recorded webinar. My name is Sanelisiwe Ganjo and I'll be your host for this webinar. I'm joined by Peter Brooke, Head of Micro Solutions at Old Mutual Investment Group. Before I hand over to Peter, just some notes about today's webinar. We will follow a 30-minute format for the presentation, and the remainder of the webinar will take the form of a Q&A session. You can ask questions at any stage by entering them into the functionality below the slides on your screen. Please note that this webinar will not carry CPD points. Enough from me, and over to you, Peter.
Great. Good morning, everyone. And thanks for taking the time to join. I'm probably going to split it actually more towards Q&A because I think there's a load of questions out there and I want to make this as valuable to everyone. So I'll do a bit of an introduction and just in terms of what's happened, where we are and what does it mean, and then move across to questions. So I think an important point, if you go to the first slide, is just giving you an extent of how big the move is and how fast the move is. This is the fastest crash since the Great Depression. And so it's not the biggest crash, it's not the longest crash, it's the fastest. It's the speed with which markets have dropped. And I think that's important if you think about speaking to your clients. It's been happening, and when they open their statements, it's going to be quite a big shock. Now, weirdly, one of the benefits of that is that actually it's too late to panic because the crisis has arrived. And that's sort of, if you look at the background, the fire has arrived. It's not coming, it's here. And just to give you a sort of a sense in terms of that's the extent of the fall on the JSE, 28.4%, but broadly, every market in the world has crashed, a crash being a definition of a 20% fall, and it's also spread out much wider. So you've seen even like safe havens like gold shares were falling. Recently, inflation-linked bonds in America have actually sold off. So it's been a typical panic in terms of just get me out, get me to liquidity, get me to cash. And it's interesting to see what I show you there in that slide is just the drawdowns. And that's across the range. So obviously the more conservative the fund, the more protected it is in terms of the impact. But these are fairly sharp drawdowns compared to our historic experience. So where we protected the funds, for instance, by having more cash and more bonds, that's obviously helped, but South African bonds have also sold off. So less protection there. The big beneficiary within our funds was we had some short positions on S&P 500 futures, which obviously benefits when the market crashes, and that helped protect the funds. But very fast, very sharp. If we understand what's behind that, and you go on to the next slide, I think it's important to understand the COVID-19 virus is obviously very scary and very real, and we're taking it extremely seriously. So for instance, I haven't been up to my desk today because our team has been split, so I can't go and contaminate the rest of the team, working from home with a split team basis. So it is very important, but its impact is actually around the real economy. It's the fact that everything's shut down, it's restaurants, it's flights, it's tourism. The actual economic impact of the virus is the shutdown, not the virus itself. I think there's no doubt in my mind that we have a global recession. So that's one element of it. The second element of it is arriving at the same time, and I think in this noise, people might have lost sight of this. is we've got an oil price crash. And that is a geopolitical issue where the Saudis and the Russians have decided to fight each other over the oil price. The relevance of that is it caused a credit crunch. Because US high-yield bonds have got a lot of shale producers, that triggered a credit crunch, and that's what caused the liquidity panic, where suddenly liquidity stopped and you saw markets drop 10 in each day. So those two factors combined, and I think the way to think about this is we've got a bit of a role model with China, because China shuts down every year for its New Year, and that's what the world is going to go through. So you have this very sharp drop-off, and then you do get a rebound. And in fact, China, because of the virus, it shut itself down. Now it's starting to come back to work. And I think what we will be grappling with is how long and to how sharp is the extent. But when we look at the macro data over the next 3 months or so, it's just going to stop. And for South Africans, it's an interesting one because on a relative basis, we are already in recession, so we actually look a little bit better because the rest of the world has to stop. My concern about that, though, is our shock absorbers as a country have been flattened. So for everyone else, they've been having a boom time. They've got a bit of cash in the bank. We don't have cash in the bank. Although our corporates are not excessively leveraged, which is important in terms of surviving. So it's actually more about the man on the street. It's small businesses that I think are going to take enormous pain here. And I can't believe that in this environment we don't go to junk status, because a recession coming on our bad data, but I largely see that as, well, it's well priced in and it's noise. I don't think it makes a difference compared to the scale of what's happened. So that's where we sit in terms of the macro. It's going to be very, very tough, and it's going to be very tough for individuals. It's what sort of cash have you got in the bank? Small businesses are going to be battling to manage cash flow here. Just in case you're trying to follow the slide, so the first one, the fire has arrived. The second one is the burned aftermath. The next one is green shoots. Next year will be better. And reflecting the seriousness of this, monetary policy's gone all in. It's emergency cuts across the world, taking cash rates to zero. And that's broadly happened everywhere. So the Fed has gone to zero. We've seen everything else. Our Reserve Bank hasn't done anything, but I don't think we should be talking about 25 basis point cuts. I think we will be talking about 100 plus cuts. And certainly through the cycle, interest rates in South Africa are going to go much lower than anyone would have expected. Just remember, with the oil price, there's two effects there. So the initial effect is it caused the credit crisis. But in any war, there's winners and losers. And the losers are the producers who are getting a lower oil price. So Saudi Arabia and Russia. The big winners are the importers. And South Africa imports roughly $15 billion worth of oil. Or that's what it did last year. You take where the price is now, we're saving $7 billion. That means a lower pump price, probably a rand off. That helps all of us, and what it will also do is it will pull inflation down. So even with the rand weakening, I see inflation falling sharply in South Africa, and that enables the Reserve Bank to cut rates. I think rightly so, everyone has highlighted that lower interest rates doesn't cure a virus. And the only thing that's actually going to help on that side is fiscal policy. And once again, we're seeing an unbelievably quick response. So what has to happen is cash has to go out to individuals. And in fact, South Africa, if you think about social grants, that's what we do. The US is probably going to embark on exactly the same thing, and they will just pay out checks to enable people to get through this process. So fiscal policy is what can move the dial. We expect it to come. And then it's always darkest before dawn. Because everything shuts down, you run through inventory. Everything gets used up, and then on the other side, you get a very sharp inventory cycle. So what I see is a very sharp down, unprecedentedly sharp, because the world is stopping for the next month. That creates an unprecedentedly sharp recovery on the other side. And just to be clear, COVID-19 is not going away. That will remain. It's the recession goes away. So in terms of thinking about this, next year will be better because as you stop, when you restart, you get a very sharp rebound. In terms of impacts on markets, if you just go forward one page, you know that every 6 months we update our expected real returns. I've done an interim update. Interestingly, I don't do these that frequently. 5 years ago, on March 2015, I actually did an interim update. And the reason I did an interim update then was to say things are really stupidly expensive and we're increasing cash and bonds in our portfolio. Today, I've updated it again to say things are incredibly stupid, but on the other side, in terms of very cheap. So what I showed you there is the expected returns. So South African equity's gone up to 7% real. That's 50 bips better than it was in December. And it's 2.5% better than March 2015, 5 years ago. The property one, I put 10%. The truth is the number's much higher. I can't actually put the real number down because it just seems too unbelievably high. That's up 2.5%. That's 6% higher than a year ago. And then South African bonds, very importantly, at 5.5% real. So 1.5% higher than 3 months ago, and 3% higher. Cash, I've cut that by 1% real. And this is really important because as interest rates fall, the return that you're going to get on cash is going to be lower. So I think the knee-jerk response is I can't take this volatility, get me out of here, and I want to go to cash. And cash will beat a falling equity market. But it will not give you the yield that you used to get. It will not give you. So if people, particularly elderly people, just think about an income fund. So for me at the moment, one of my strongest messages would be you want to be going out of cash into real income. So I completely understand you're not going to be able to convince your client to go out of cash into my flexible fund, which is in the aggressive end, because people's pain threshold is just not there. But cash yields are going to fall. You have to try and get income, and where you have some duration, where you locked into longer term rates, like in a real income fund or the income fund, you're going to get a much higher yield. Look at the real return on bonds at 5.5% versus the real return on cash at 1%. That's a really, really important factor now. Globally, bonds are down to zero, cash is down to zero, therefore you're getting negative real returns. and equity overseas has got cheaper. Importantly, it wasn't that we were quite cautious on global equity in terms of getting more expensive. So it has got cheaper. It's not at a level where I would mortgage my house to buy it. So where we've been adding equity, and I want to be clear, is that last week we were buying shares on behalf, so we're taking the cash that we built in our portfolios and we were buying the market, because that's what we do. We were focused a little bit more on buying South African shares because of that higher real return, because they've fallen very sharply in this. The net result of that is the real return on a typical balance fund has now gone up to 5.5%. It's 70 bps better than it was, and it's 2% in December, and it's 2% better than 5 years ago. It's hard to explain. This is a very long-term number, so it doesn't change very much. If we take a short-term number, so the quant models that Graham runs on SA equity suggest a 25% return from here over the next year. If you re-rate over the next 5 years from where the current PE is to a reasonable PE, you will get much higher real returns than I'm suggesting. So the context is this is a slow-moving number and doesn't actually reveal the potential upside. That potential upside, I would be surprised if it's going to appear in the next 3 months. So yesterday US markets are up 6, yay. Today they might be down 10. It's incredibly volatile because no one knows how to price for this COVID-19. But longer term, they will go up from here. So the picture that I've tried to give as we've gone through, if you look at the slides, is a very quick fire that's burned through. It's going to be really tough in 2020, and the important focus is how do we survive? That's at a very personal level in terms of individuals, but companies and balance sheets. The next 3 months, no cash coming in is going to be tough. It will get better because of the stimulus that has taken place, and we will not remain shut down forever. That recovery will mean that 2021 is a better year, and then the long term, the base is set now for a very good real return. Cool. So that's just sort of giving a bit of a feel for what's happened and where things are. I'm going to move across to the questions now. Yeah, what have we got? Okay, I'm just going to click through them. Okay, you can't scroll through them that fast. I can't read that quickly. Is your global future return expectations in rands or US dollars, was the question. The answer is it's in real, so therefore the difference would be the nominal depreciation of the rand. So I'll give you an example. If you get global bonds at -1.5, in rands, you'd get a 3-4% depreciation. So you'd get about a 1.5% rand return. The rand returns are obviously in rands. In terms of the currency itself, I think we're seeing real value in South African assets. It's hard to say that there's real value in the rand. The rand actually hasn't sold off that much. We sort of thought it was about fair value at 15.50. 16.50, it's a bit cheaper. I think the big issue here is that the US dollar structurally didn't hold up as well as a store of value in a crisis. And if we take through what's happened in terms of global interest rates, and if we take through what's happened on money printing in terms of giving people checks, sending checks in the post, it's hard for me to see a strong dollar on a structural basis from here. So you get the flight to safety typically in a crash. It didn't actually get that. What you did see was a flight away from risk. So the Brazilian real, the Russian ruble, the South African rand weakened, but you didn't see the dollar strengthen. As a result of that, I'm fairly relaxed about the South African rand from here. Interestingly, we got some feedback from Impala. Remember, the mines have been dealing with health issues for a long time. And actually, I think they will continue to produce our precious metals, and I think there will still be demand for those in this type of environment. So I think we're okay. We will get a bit of a negative impact from tourism. We're a net beneficiary of tourism, so that's going to hurt us quite badly over the next 3 months. Okay, please explain the balance fund average of 5.5% on the slide. That is 5.5% real. So you'd add inflation on top of it, and that is just a weighted, we take a benchmark for a balance fund and we times it out by those allocations. So for instance, you've got 5% in property and you've got your money invested in bonds, and that's how you get to the money, get to the 5.5. Does your short-term and long-term models have variability around the expectation? So the long-term tends to be fairly good in terms of indicating direction, so returns will be much better from here. Typically, when it's looking as good as this, I would expect it to over-deliver. In terms of short-term, basically, we treat those with a high degree of suspicion. So the 25%, we don't use that. We don't base our investment decisions on that short term because of that high degree of variability. We use the long term, and that's why we're buying today. Loads of questions about Sasol. Would you buy Sasol now? No, is the short answer. So in terms of our philosophy and theme and price, Sasol has fallen a lot, but it is bad theme. In that environment, that we tend not to double up because there's better uses for our money at the moment. We can get better risk-adjusted returns from other companies who've also fallen. A fair amount of that Sasol fall is driven by the lower oil price, and I think on a structural basis, the OPEC price war will mean a lower oil price for a number of years, and the fact that Sasol is highly geared means that it cuts it deeper. So there is genuine damage. So I don't think Sasol is going back to the price that it was a year ago in terms of a rebound. The truth is incredibly volatile from here. It's moving in 20% jumps on a day. We will not be adding our capital to that at the moment. A lot of questions about property. Property for us is also bad theme. So in an environment where you're shutting down shopping centers for 3 months, it'll be very interesting to see what happens. The retailers have a contractual obligation to pay the property companies. So it's better to be a property company than a retailer, because the retailer relies on people coming through the door to buy. But you need to look through that, because actually the next 3 months nothing will make sense. It's when we're investing, we have to think about what will be happening in a year's time, and people will be back in the shops, and people will be buying. Structurally, we've had property as bad seen for a while. So for instance, if I take my flexible fund, the flexible or any of the Edge 28, these type of, so I'm just really speaking from, they should be fully invested. Typically, we would have property of 10 to 15% of portfolio. We cut it to 5 because there's excess supply in property. With what's happened to the price now, we will be looking at adding to property, but we need to be very careful about buying companies that will survive this. So a couple of the listed companies will not survive this event because of their high gearing. So if you just think of Into as a good example, high quality property, but too much debt on the balance sheet. So what we've been doing is we've been moving into lower geared companies within the property space, and we've cut our property exposure. Now at the current price, Growthpoint is on a 17% yield. If it survives this, you should sell your house and buy Growthpoint. So that's what we're looking at and working on at the moment, because it's just, this is real panic and real fear. And for a well-diversified business like that, I think that we're perfectly happy to own it. Some of the other stuff, unfortunately, will not make it. So you've got to be careful. Okay, there's another question. I don't understand the small change in growth, say on equity, plus a half from December 2019. So it's gone from 6.5% real to 7% real. As I tried to explain, this is a very long-term number. So in terms of actual, quite frankly, in 3 months' time, 6 months' time, I would expect the market to be at a very similar level, so just very volatile. But from there, I would expect a large double-digit return in the following year. That's when you're talking short-term. The truth is, if you go down to short-term, the market's moving 10% per day. And we have no credibility or conviction in saying point-to-point forecasts over short time periods, and therefore that's why we don't do it. But I do believe that we're building up. That's why we are buying shares at the moment. We are building up to some very big returns on a 12 to 18 month view. There's a question here, what can a client expect who is currently invested in an income fund? The truth is the income funds are very safe in terms of their certainty of return is driven by the cash yield, by the yield that is embedded in the fund. What I'm suggesting is that the ability to reinvest that income fund as interest rates fall, so 12-month NCDs are going to fall in yield. So today you might own it in the income fund, but when you come to reinvest it in 1 year's time, South African cash yields are going to be much lower, so yields will fall. We will try and put together a yield summary of the different funds in the course of the next week and send it out into the channel. So we'll get what Future Growth has on their bond fund, their income fund, our real income fund, and all of those funds, and send it out. Cool. We're starting to run out of questions and we're starting to run out of time. There's a question here, what risk does this place on your SA positioning views, as this virus impact will depress SA's recovery for longer? I think it will definitely depress SA's recovery. It will hurt everyone's growth. So all markets are falling and all markets are hurting. I think for South Africa, that rebound can't happen, and we extend our recession. And so, for instance, on our, let's say our balance funds, or we're running at the 30% offshore. And we've got a fair amount of cash and bonds in South Africa, which will give you the income that comes off it. I think for SA companies, that expected rebound in profits is going to take longer. As an example, some of the shares that we bought last week, we bought Pick and Pay. We were looking for high quality companies that will still produce profits in this type of an environment. So your prices dropped, all prices have fallen, so rather go up in quality. For those companies that we already own, where the tailwind in terms of growth is not going to come through, if they have a balance sheet problem, we've actually reduced exposure. Other ones, we've held our exposure. There's a question on inflation. Inflation is going to fall. Johan will send out more detailed forecasts of that as it comes through, but I think a rule of thumb is we're probably going to be around 4.5. On our longer term inflation expectation, so we think inflation will fall in the short term, and actually it's quite interesting because one of the big factors that keeps our inflation up is regulated prices, but also wages, where everyone expects a wage increase. Realistically, I can't see us getting a wage increase at Old Mutual Investment Group. I think, and in fact, we might be getting wage cuts. And I think almost the whole country has to consider zero wage increase. And that will allow government to save the money to put out food aid. Because in the next 3 months, we're going to need that for the hardest hit people. And I think, this whole conversation has been about investments, but there's also a social impact. And I think we mustn't underestimate how tough things are going to be out there for the poorest of the poor. Cool. Look, there's a horde of questions are now flowing quite quickly, but I don't know in terms of we're on the time limit. Who's in charge here?
So Peter, thank you firstly for the insights and the presentation and for answering the questions that have come through. We have unfortunately run out of time. Also want to extend thanks to the audience for sending in those questions. We really hope you enjoyed listening, and we hope to have you log in next time for the next webinar. One more point.
And just a closing point is I am doing a weekly voice note that goes out on WhatsApp, which enables us to put our views out live and as quickly as possible. So if you're not receiving it, please speak to your Old Mutual representative or Gonse, who will be able to sort you out.
And then that concludes this webinar session. Thank you for listening and goodbye.